Good day, everybody. This is Jim Kenney for OptionProfessor.com for May 3rd, 2019. By way of introduction to new listeners here, I'm Jim Kenney, a graduate of Boston College, and I have been in the investment arena for decades now, and most of my time with education has gone into seminars on options, both online and in the hotels. And basically what we went over is the uses and the risks of options, using them for limited risk speculation, using them for cash flow purposes, and also using them to hedge or protect your positions. Basically, what I'm going to do today is I'm going to go over, as I always do, what's going on in the markets, what's going on in the world a bit, and try to give you a little bit of an idea of what's happening. I was speaking to some people regarding hedging yesterday. Just give you a review, though, on what I've been saying, what I've been thinking. When we hit down around the 2350 area, my feeling is that we were very oversold because the 200-day moving average was up at 2750. At that point, we did have a very big move back to 2750, a 400-point move, and it happened rapidly. So when I hit that 2750, I try to do some more homework in different areas and get some idea of where people research was saying where we could be headed. And a lot of people are saying we were going to head and test to the high, and I subscribe to that. So basically, we just did that here this week. We not only tested the high, we took it out by a little bit. Okay, now then we did pull off quite a bit, and then we went down to 2,900, and then with this unemployment report, bam, we're right back up towards the highs. My feeling is, at this point, my opinion, as everything today is, and my observation is 2,950 to 3,100 is the range of which, in my belief, the market may run out of steam. Why would it possibly run out of steam? Well, there's many reasons why it will or will not. I'll give you some ideas on what I'm thinking. The VIX and the put-call ratio are in pretty frothy levels lately, showing a lot of complacency, and complacency and high prices sometimes don't end that well. Again, we've got a lot of things that could be happening here that may not break the right way. Okay, now today we had a great unemployment report, way more jobs than they expected, and the inflation on the wages was moderate, and so people are very happy with it. In order to get these jobs, though, we are going into heavy deficits, and people are not worrying about that. Like most people who borrow money, they're not worried about it when they're borrowing it. When are they worried about it? When they got to pay it back, right? So again, that is something that you have to bear in mind when you see all these jobs being created. But again, going over some of the things that I'm concerned about here is obviously we've had a very long run. The moving averages are in the 2,700. We're up there almost 3,000. And there are things that may not break well. Like what? Like a no trade deal or a watered down trade deal with China. Maybe it'll be a sell the fact deal. People were thinking that we're going to have this insurance cut. There's no insurance cut happening right now as far as I can see. So anybody who bet that way, I think they're betting wrong. Third thing is the China recovery. We've had a very big recovery in China, but if you notice, the surrounding areas, South Korea, Japan, Australia, New Zealand, whatever, Indonesia, they're not really getting a lot of jam out of the internal stimulus that the Chinese have done. And some people think that the Chinese recovery may also be petering out just a little bit. So that's something to keep an eye on. Valuations, what are we, 17, 19 times on future earnings? And future earnings are not guaranteed, right? So the thing is the valuations are a little bit rich. What else could be happening here is the ISM number is last time we were up at these highs was last October. And what happened in last October was the ISM numbers were screaming. Now the ISM numbers just hit the 2016 lows. And basically, you're looking at the market making new highs while the ISM doesn't seem to be confirming it. In fact, globally, there are more countries with their PMI numbers under 50, which is contracting, than we've seen in a very long time. So that's a factor to keep in mind. The Russell and the transports, I'll get into that in a little bit. While they've had rallies, they have not taken out their all-time highs like the NASDAQ and the S&P have. So there's a little bit of a divergence there you got to keep an eye on. Earnings, everybody's saying, oh, this guy's beating earnings, this guy's beating earnings. All I know is on a year-over-year basis, it looks like we could be hitting a bit of a recessionary tone in the earnings and the revenue. And that can be problematic at some point. IPOs, initial public offerings. I heard there's 16 more coming, and there's a tremendous amount coming out that are losing a lot of money, but they're still raising money. In fact, Tesla just raised, I think, or is in the process of trying to raise another couple of billion. And so in this environment, when you can go to market with a big losing company, sometimes that's a sign of a little bit of excess on the upside. Seasonality certainly is not every year. In fact, in the last 5 years, May through October hadn't been that bad. But on a long-term basis, it has sometimes been problematic between May and October. Doesn't have to be that way, but I'm just trying to say longer term, the numbers favorable to a softening during that period. 5 years, it is not so much. Okay. And then, of course, there's a chorus of people talking about a melt up. And of course, that is also an indication that you might be at a higher level. So again, to recap my view, 2950 to 3100 would be a zone where I think the market could run into some either pause to refresh or pullback. And ergo, if you know how to do covered call writing, if you know how to do collars, if you know how to do married puts, this might be the time, or replacement trades where you get out of a stock position and replace it with a call option. These are tactics that people at a higher level in the market would at least start investigating. Now, if you don't know what I'm talking about, that's why I invite you to shoot me an email at optionprofessor@gmail.com. That's OptionProfessor @gmail.com. And if you have a specific situation or you have a specific strategy, I'll try to give you my opinion and my input on how the strategy works. And then you, your clearing firm, your advisor, whoever you're working with can determine suitability and feasibility between yourselves. Okay. All right. Now, again, big move up today. Let me just refresh the screen here and see what the more current numbers look like here. Give me a second. Okay, so we went up about to 26.5, 525 or so, and now we're backing off just a little bit from the highs as the close is going to be coming up in about 15 minutes. Let's talk about the two things that I was talking about, the transports. Let's see. I know they had a big turn yesterday and they followed through today pretty good, but they're still at underneath the recent high, and it's also underneath the all-time high. There's your all-time high where the cursor is, and there's the recent high. So if this thing starts taking out 10.5 on the downside, that would be a little bit of a sign to me that we're rolling over. So keep an eye on that support zone right around, what is it, the last week's low or this week's low, something like 10, looks like 10.6, 10.7, whatever. Certainly if you get under 10.5, that would be a better situation to indicate that we could be rolling over. The Russell tried to get above 1600 again today. Let's see how that worked out. Again, 1600 has been problematic for it, and it did. And it looks like if it can close above 1600, that would be a positive thing. Now, if you're going to get some kind of a melt up like they're talking about, it might very well be with the Russell jumping up to 1700 and trying to test those highs, or the transports going for 10.9 up to 11.6, 11.7 and testing those highs. That might be what could happen if the thing gets on the bicycle next week. Okay, but as you can see, so far, the resistance around 1600 is pretty much still in play. And of course, the highs of 1742 is also still in play. And that was again at near the fourth quarter of last year. Again, that's the time when the ISM numbers were appreciating and going, and we don't have that happening just right now. The GDP came out, and it was 3.2%. But if you took behind the curtain, look behind the curtain, you'd notice that the consumer spending was a little bit weaker. Now, to be balanced, consumer spending did pick up in the last report, but in the first quarter, it wasn't that great. And capital spending, of course, also wasn't looking that great. So you got to keep an eye on those type of things and see what's going on. One thing to be bullish about, though, is productivity. And one of the things that people are worrying about is where is the inflation? Because, when you've got this kind of debt being run by the government and you've got this type of employment picture, and people are making more money, albeit by 3% or better, generally, historically, you'd get some jam on the on the inflation rate. Well, productivity in the first quarter was up 3.6%. And in the last 12 months, it's up 2.4%, the best since 2010. Now, this kind of allows growth without inflation, which is pretty much what we're seeing. So if you want an explanation on why you're not getting see much inflation, it could be the productivity number. keep an eye on that. Like I say, I try to follow the numbers. I try not to, stick with an opinion against all odds. Marty Zweig, 30 years ago, used to say in meetings that I was at with him, don't fight the tape and don't fight the Fed. And that's not bad advice. The tape is rising right now. I'm just saying with my 2950 to 3100 area that the trees don't grow to the sky, right? But there's no pattern up here that would indicate any turn. So obviously it's premature to really look for that. If this Russell were to take out 1550 and then 1500, then you'd have a pattern that the thing has lost some altitude. Let's take a look at the S&P and see what that would mean. Okay, on the S&P, 2945, the recent high 2954. You see this area of 2900, that low that we saw on the pullback? I'd watch that one. You start taking out 2900, I think it would open the door for a more significant drop, either 2800, or if it was going down for a good reason, even down to 2700. So again, watch that 2900 area. If we can't take out the high of 2954 and we take out the 2900 and you start seeing the transports deteriorate and the Russell, then you'd have good reason to think that you have somewhat of a pattern that it could be short term rolling over. Obviously, the market does seem to be in a bullish situation. The question is there going to be a pullback? Is there a pause to refresh? And of course, the higher you go, in my opinion and observation, is the odds increase that that might occur. Because the higher you go, it doesn't become less overbought, right? Right. Okay, so let's just take a look at some of the stocks that were in the news here this week. Apple came out and they had people very excited about their earnings. And again, Apple has not taken out the 230 area, which is the all-time high, 233. It's still down here at 211. And of course, it did pop up, but not so far following through. And so basically, if Apple were to get back under 200, that would be an indicator to me that that short-term drop might be in fact. Again, it had big volume here. Don't forget, when everybody's buying something, somebody's got to be doing what? Selling it, right? So obviously, if every Tom, Dick, and Harry's trying to buy into Apple, as they look like they have been recently, then somebody is going to raise the offer, right? And then when they raise the offer, again, they have a feeling, more than likely, that the volume is not infinite, and that after that big buying volume, like we just saw here, where it jumped over 50 million shares a day, that again, because look at the volume here at the lows, right? After everyone is sold out, right? The market has an ability to rise because you've exhausted the sellers. On the same side here, this is not as extended as these over here, but it might be a situation on a short-term basis that the buying activity could dry up volume-wise. And again, the volume on many stocks during this advance have not been as big on a 50-day moving average basis as it has been on a 200-day moving basis. Okay, let's look at a couple, because these stocks here that I'm mentioning, they represent almost 50% of the advance the NASDAQ has had. So I'll give you the 4 stocks here, and you tell me what you think. Facebook. Okay, another one that came out with earnings that people were excited about. And again, it still hasn't taken out its high of around 220, but it is up here and it's trying to fill that gap. That's a big gap, right? And it's come up in here and filled the gap. Now you got a little gap underneath. So if this thing started taking out 180 again, and if it even takes out 190, the odds are going to start increasing that it might be having a short-term pullback. But again, that's what it looks like as far as Facebook is concerned. All right, the other one that is in on the 4 horsemen here is Microsoft, and that's a company that just keeps giving, and that's up at 128.85. The all-time high is 131. So again, you see this low at 125. If you start taking out that 125, that might be an indicator that a short-term correction could be in the works, because again, that's the low. That's pretty much like 2900 on the S&P. Similar kind of look, right? Okay, and so basically that's some stocks that obviously are big on it. And let's look at Google, because they did disappoint, particularly on revenue. And that's a big thing to disappoint on. And let's take a look at what Google looks like on the screen here. And of course, when you disappoint on revenue, people don't like that. But again, when the volume is big, sometimes you get a short-term low. And that's basically what we've seen so far. And a lot of people said 1150 would be the number. I think that's the 200-day moving average. So that 1150 is a big point. It's also a 50% correction from here to here, back down to here on the recent move. So at 1150, it gets underneath there, then you've got a different story. If not, and you wanted to be a buyer, that's not a bad line in the sand if you want to quantify your risk to a certain level. Looks like 1150 is not a bad level to use as a support. Okay, and there's a big gap there. So, if this market's going to have the quote unquote melt up that people are talking about, this thing probably might go in and fill that gap a little bit. All right, so keep an eye on that. So there's the four ones that really run the show, because some of these indexes are weighted, right? So some stocks movements are a little bit more important than others, and that's why you've got to get an idea on that. Some of the sectors that have not done very well, one, of course, has been the healthcare and biotech. And on the healthcare and biotech, again, we saw a good bounce on United Healthcare. Same idea. Every Tom, Dick, and Harry sold it out, and then basically that was the low. I'll show you exactly what I'm talking about. So these high volume buys and sells, you got to be careful of. Look at the low there, and look at that volume. That's a huge volume, right? So that means that's a ton of selling. Some people might call it capitulation. That's certainly a line in the sand I would respect, though. This 210, 208 area that it hit, don't forget, it came down from 287. So again, it did stop at 240. If you want to be bullish, I would like to see it above 240. Okay, because that's been the short-term high, and you could be setting up for a 1, 2, 3 formation. 1, move up to 240. 2, pull back here, stops pulling back, doesn't take out the low, and then you take out 240. Then you could build a little bit more of a case that it might go, because you see here it tried to do a 1, 2, 3. It went up to 260, pulled back, didn't take out the low, but it couldn't take out 260, and it gave up. So that's why I'd like to see it take out 240 before I'd get more constructive. If I was looking for a bounce, certainly when I saw that volume and when I saw that 208 area, that certainly looked like a good place to look. So they give you United Healthcare. The oil market is getting whacked, and it's getting whacked hard. So let's take a look at what's going on in oil. A lot of the big companies, I've been telling people that people wanted to get into Exxon, and it was like 82. I go, well, if you're getting into Exxon at 82, you want to put it on a short leash, because the 50-day and the 200-day average is right around 80. So this thing starts breaking under 80, I don't think you want any part of it. Let's take a look at what Exxon is doing now. Exxon's at 78. It's up a little bit today, but it has gone as low as 77 today. And basically, you're looking at a chart that probably also is breaking down. You see, this 80 area was kind of important. So the longer it stays under 80, those moving averages will roll over and start pointing down. If it can get right back above 80, fill that gap, and even get above 85. In fact, I'd probably want it to get above 85 before I'd be constructive on it, because otherwise you've got a lot of resistance there, a lot of resistance here, and why get into something with a bunch of resistance? If you're looking for 90, it can't get there until it takes out 84, right? Okay, and so that gives you one idea on the oil. Let's see a couple of other ones. What's Valero doing? Valero's up a little bit today, but as you can see, it's gone from 126 all the way down to 89. So that has not been a friend to too many people. So, the one that really got whacked was Fluor Corporation. They do a lot of stuff with platforms and things like that. They're in Irvine, California. When I first moved to California, I used to be right next to them. And they got really murdered the other day, as you can see in a minute. They went from 42 down to 30. And look at that volume. So this would be the kind of thing where you'd start looking around to see if there's any support, any pattern to look at, because with that kind of selling volume, you'd have to think that a lot of people who want to sell are out, and there's a big gap there. So that would be something to look at if you thought there could be a bounce. Look for a formation that you could work with, and look for something that might be telling you that there could be a bit of a turn. The low looks like it's in the 27, 28 area. We're only at 29. So again, monitor that, because that is a very, very big drop. And again, it used to be 60. So again, you're talking about a company that has a P ratio of 18 and is paying a dividend. And so, monitor that and see what you think. A lot of people, a lot of large investors love Suncor. That's the Canadian one. Let's see what that looks like. Because, when things are on sales, when you want to sniff around, right? And again, the volume's been kind of back and forth on this, but it still looks like it's on the defensive. Occidental Petroleum, supposedly, if they are going to be successful getting Anadarko, that Buffett, I think, is supposed to be participating in that, for what I read. Oxy's up at 58. Let's see what Mr. Buffett is looking at here. That looks like it might be interesting. Well, you can see it's very close to the 52-week low, 56 and 58. That's pretty close. You can see the volume's been very, very big down here. So could be something. Keep an eye on it because, again, it is a news stock. And as the news goes, it goes. Okay, so again, looking at some of the different sectors, let's see what sectors look like they are working out for people and see what things look like. Let's start with tech. Again, tech is the one everybody wants to take a look at to try to get their alpha. And I'm going to use the Vanguard ETFs. This one's going to be on healthcare. As you can see, healthcare had a big drop from 180 down to 160, but it's on the rebound right now, as you can see. Some people are thinking there's a buying opportunity here because people are overreacting to this socialized medicine or Medicaid for all or single pay or whatever they're talking about. Me, I would like to see it get above 175 because to get to 180 or 185, you have to get above 175. If it can't get above this resistance, then obviously the future is pretty limited. All right, let's talk about we talked about energy. Let's talk about communication because you know what? There's a lot going on there, 5G and all the rest of it. So let's look at what the ETF looks like on it. As you can see, again, nice uptrend there, pull back. You see the tail there? That tail looks just like the Microsoft tail. It looks very similar to the S&P tail. So that's not a bad line in the sand on a short-term basis. And then, of course, like I say, if you're a believer that the communications sector is going to be doing well. Some people like telephone, some people like Verizon, some people like Sprint, some people, like T-Mobile. These are some of the names that people are keeping an eye on in the communication sector. But certainly it has been on the bicycle a little bit and has been participating in the rally quite a bit. Okay, another sector to take a look at that everybody's talking about is the financials. The problem is they've been talking about it for about 3 years. Now, the financials have been on the defensive, but they have been making a turn. As you can see, we're getting close to the 52-week highs. If you go over a 24-month basis, though, or even an 18-month basis, that high would be around 80-something. Okay, so this is, or I don't know about on this, but on something like Citicorp, it would be. Again, it's on the bicycle. It's up near some resistance, right? So if it can break through this resistance, then, of course, resistance between 70 and 74, then you've got something that has an open field ahead of it. Again, some of the big stocks in the financials, you know the names. Let's take a quick look. First one would be JP Morgan. People call that best of breed. Let's see what best of breed looks like. 116, again, up near the high of 119. And we'll have to see that tail right there at around 114, 114 and a half. I'd keep an eye on. Start taking that out. It might put that gap in play if there's going to be a short-term pullback. If there's not, and there's going to be a melt-up like these people on TV are yelling about, then, of course, you can forget about the pullback. It's going to go up. But the point is that, I think there's enough cautionary flags here. But again, the top of my ceiling is at 3,100. So I'm at 2,950 is the starting point, which we're here basically now. And then the top of the, I would call it the red zone that it might die out at is 3,100. And certainly a move from 2,950 to 3,050 will get a lot of people excited. But the more excited they get, the higher it gets. Sometimes you have to be careful about that. So again, let's take a look there, and that is JP Morgan. Another one in the investment banking area, of course, is the Goldman Sachs. And that was under a lot of pressure for a long time, and now it's back above 200. This thing went from 245 down to, I think it was like 175 or so. Oh, make it 150. So that basically had a collapse down there. And then since there, it's been going. But you notice it's having trouble at the 210 area, and there's your lows. So getting above 210 and closing there and trading above there would be important to me if I wanted to be constructive on Goldman Sachs. But the financial sector certainly has gone on the bicycle again. And again, if we're going to have this great economy and everyone's working and everyone's out spending, then bottom line, you would think the banks could make a buck or two. All right, the industrials. The industrials were doing very good for a while, and then they took a pause, but I think they're back on the bicycle. Let's take a look. Yep, there they are. So they went in the tank, just like everything did in December, when everybody thought the Fed was going to keep hiking forever. And then, of course, after you get a drop like this in the market, the Fed's probably not going to hike, right? And that's why they're on pause. They're on pause because they thought that obviously this is not the time to hike further, right? Because why? The markets are tanking. So they're on pause, and going on pause got everybody excited again. But if you look at the earnings year over year, the sugar high of the tax cut is gone. And revenues and earnings year over year, okay, is looking a little bit dried up. So that's why these earnings in Q2, Q3, and Q4 are imperative to keep this market alive. Because if they don't deliver some goods, you can't keep the market up just on its good looks. It's got to give you some earnings. It's got to give you some revenues. Okay, so there's your industrial sector. Let's turn to utilities, which I think could be in jeopardy, and let me show you why. Utilities have been great, right? You'll see that in a minute. Look at that. That looks great, right? Been going up good, and the interest rates went down, right? Interest rates went down, and utilities love that. Yields on 10-year treasuries went from 3.25 down to 2.3. That's great for the utilities, and that's why you get the BAM, right? But now it looks like it's kind of stalled out. And if it starts taking out this area here, and the 10-year note gets above 260, 280, which I'll show you in a minute, then this stuff could have vulnerability to the downside. So I'd watch this closely because it does look like it's stalled out here. The question is this stuff here called distribution, or is it called accumulation? If it's accumulation, we'll break out to the upside. If it's distribution and you take out 126, 125, whatever number you want to use, 127, then you could be in hot water if you're long, and then the dividend you're getting might be the only thing you make money on. Let's take a look at that 10-year treasury so I can show you that right now. The 10-year treasury is at 253 today. So the yield has dropped just a little bit today because, again, the wages were not that strong. But you see this tail there? It looks a lot like 2,900 on the S&P, right? So, again, if we can get above 260, which I mentioned to you, and then get above 280, like I mentioned to you, I think the utilities could come under some significant pressure. So keep an eye on that. That tail right there looks like a pretty good low. So if we get above 260, the odds of higher interest rates or higher yields will increase. There's one thing that's not being factored into this economic picture at all, in my opinion, and that's the risk of inflation. So again, the risk of inflation is something that has to be talked about, because if inflation comes back with all these deficits, with all these people hired, all these people making more money, if inflation does come back, there is no, in my view, discounting of that at all, either in stock prices or clearly in the bond market. Now, I'm going to be wrapping up here today. What I would like to do, again, the international markets, I'm just going to give you a couple of stocks that I keep an eye on. Let's see what BABA's doing. And BABA is one of the lead dogs, so you got to keep an eye on that. It's right up against resistance at 200. You see, that's what people are wondering. Are we going to have the melt up? Well, if we get above 200, 210, that would be more evidence that we might. But if we can't get above 200 on BABA and we start going under 180, again, that might be your tip that the Chinese recovery is stalling a bit, and it also might dribble over to some of the other markets as well. Again, emerging market debt and high yield debt has seen lots of money come into it this year. And when everybody's doing one thing, don't forget, somebody's got to be selling it to them. So you got to be careful about emerging markets and high yield in this environment. All right, this is a lot to cover in one time. I'm inviting you to send me an email if you want to talk to me further. OptionProfessor@gmail.com. Send it over, give me some contact information, and I'll be back with you. Again, for OptionProfessor.com and the weekly update, this has been Jim Kenney. I will be back with you next week. Until then, I wish everyone has a great holiday over the weekend. And don't forget, if you know anybody else who might want to hear the broadcast or ask me a question, again, let them go to OptionProfessor.com to get the link, and let them go and send me an email at OptionProfessor@gmail.com. If you're rooting for the Kentucky Derby, I hope your horse comes in. Enjoy this weekend, the first Saturday of May, and we'll be back with you next week.